September 24, 2019. The Gulfstream G650 sat cold on the tarmac at Teterboro Airport, engines silent. Adam Neumann stared at his phone, watching the Bloomberg terminal flash red across every metric that mattered. $47 billion. Gone. Not over years, over weeks. The IPO filing that was supposed to crown him as the next Steve Jobs had instead become a public autopsy. Wall Street analysts tore through WeWork's S1 with surgical precision, exposing losses that made even the most reckless tech investors flinch. $1.6 billion in losses on $1.54 billion in revenue for the first 6 months of 2019 alone. A company hemorrhaging cash at a rate that would kill any traditional business within months. But the numbers were just the beginning. The real damage was in the details. Neumann had trademarked the word "we," not for brand protection, to lease it back to his own company for $5.9 million. Though he later returned the payment under mounting public pressure. He had purchased buildings, then turned around and leased them to WeWork at rates that made his personal real estate portfolio bloom while the company bled. He had taken out a $500 million loan from JP Morgan, secured against his own WeWork shares, then used company jets to surf in the Maldives. SoftBank's Masayoshi Son, the man who once wired Neumann $4.4 billion after a 12-minute pitch, was now on the other end of the phone. His voice was flat, clinical, the kind of tone a surgeon uses when delivering terminal news. The board meets tomorrow. You have 72 hours. Neumann didn't argue. There was nothing left to say. The man who told Fortune magazine that he would be the world's first trillionaire now faced a choice that no amount of charisma could negotiate. Step down voluntarily, or be forcibly removed in front of every investor who had believed his vision. The silence in that Gulfstream cabin wasn't just the absence of sound. It was the vacuum left when ego collides with economics, and economics always wins. This is the story of how Wall Street didn't just reject Adam Neumann. They erased him. 2 years earlier, WeWork wasn't a punchline. It was a religion. Neumann walked into pitch meetings with the energy of a prophet. Barefoot, long hair, eyes that burned with conviction. He didn't sell office space. He sold belonging, community. A generation of freelancers and startups who were tired of soulless cubicles found salvation in WeWork's exposed brick, craft beer on tap, and the promise that work could feel like family. By 2017, the company operated in 20 countries, 268 locations, 268,000 members, paying monthly fees to access desks, conference rooms, and the intoxicating myth that they were part of something bigger than themselves. Venture capitalists lined up. Fidelity, T. Rowe Price, Goldman Sachs, everyone wanted a piece of the company that was going to elevate the world's consciousness. That phrase wasn't marketing fluff. It was in WeWork's actual mission statement. A real estate company that believed it was a tech platform. A leasing business that valued itself like a software unicorn. And Wall Street, drunk on a decade of 0% interest rates and trillion-dollar tech exits, bought every word. SoftBank's Vision Fund poured in $10 billion across multiple rounds, valuing WeWork at $47 billion by January 2019. That made it more valuable than established giants with decades of proven cash flow. More valuable than Delta Airlines. More valuable than FedEx. Neumann's personal net worth hit $4.1 billion on paper. He bought 5 homes, a Gulfstream, a stake in a wave pool company. He started referring to himself in investor meetings as a galactic leader. He told Business Insider he planned to live forever. But underneath the kombucha kegs and neon signs, the foundation was cracking. WeWork's business model was brutally simple and fatally flawed. Sign long-term leases with landlords at fixed rates. Sublease desks to members on short-term contracts at premium prices. Pocket the spread, scale infinitely. The problem? When a recession hit, those members would vanish overnight. The long-term leases still do. Every month, no matter how many desks sat empty. By mid-2019, WeWork was burning through $2 billion annually just to keep the lights on. The company needed the IPO, not to fuel growth, to survive. August 14, 2019, WeWork filed its S1 with the SEC. The document that was supposed to justify a $65 billion valuation instead triggered the fastest corporate collapse in modern history. Financial journalists who had written glowing profiles now turned into forensic accountants. The Wall Street Journal published a devastating investigation into Neumann's subtle dealing. The New York Times detailed his erratic behavior, reports of marijuana use at company events, and a leadership style that valued loyalty over competence. Institutional investors who had committed to the IPO started making quiet calls. Fidelity pulled out, then T. Rowe Price, then Wellington Management. The Roadshow, where Neumann was supposed to charm pension funds and sovereign wealth managers into buying shares, became a funeral march. By early September, the IPO valuation had been slashed to $20 billion, then 15, then 10. Every revision made the situation worse. If WeWork couldn't go public at $47 billion, what did that say about SoftBank's investment thesis? What did that say about every venture capitalist who had written 9-figure checks? The answer was becoming unavoidable. They had all been wrong. JP Morgan, the lead underwriter, delivered the final blow on September 30, 2019. The IPO was officially withdrawn, not delayed, not postponed. withdrawn. In Wall Street speak, that meant dead. Neumann's net worth, which had peaked at $14 billion on paper during the private valuation highs, evaporated. The board, once filled with loyalists who applauded his vision, now saw him as a liability. Every day he remained CEO, WeWork lost credibility with landlords, members, and the debt markets they desperately needed to tap. On September 22nd, the board convened an emergency meeting. SoftBank's representatives made the ultimatum clear: resign within 72 hours with a negotiated exit package, or be terminated with nothing and face potential shareholder lawsuits for breach of fiduciary duty. Neumann asked for time. They gave him 2 days. Think about that moment. You've spent a decade building something from nothing. A single office in New York to a global empire. 200,000 people paying you every month, your face on magazine covers, your name mentioned alongside Zuckerberg and Musk. Now imagine 72 hours to accept that it's over. Not because you ran out of money, not because the product failed, because the very people who celebrated your audacity now saw it as recklessness. Because the market that rewarded your vision now punished your execution. Would you have signed those papers? Or would you have fought, knowing the fight itself would destroy whatever legacy remained? Answer honestly in the comments below. Because what Neumann did next revealed something Wall Street didn't expect. September 24, 2019. Neumann didn't fight. He negotiated. While the media narrative painted him as a delusional founder clinging to power, the reality was colder, more calculated. Neumann understood that his leverage wasn't control. It was chaos. If he refused to step down quietly, WeWork would spiral into bankruptcy within months. Landlords would sue. Members would flee. Thousands of employees would lose their jobs. SoftBank couldn't let that happen. They had already invested $10 billion. Letting WeWork collapse would trigger a crisis across their entire vision fund portfolio. So Neumann did what any battle-scarred negotiator would do. He made them pay for his exit. The severance package was obscene. Approximately $900 million to $1.2 billion when factoring in stock sales, consulting fees, and debt forgiveness. Critics called it a reward for failure, but Neumann's lawyers framed it differently. He was absorbing the reputational damage so the company could survive the transition. On September 24th, Neumann officially resigned as CEO. The press release used terms like mutual decision and new chapter. Inside WeWork's headquarters, employees gathered in silence. Some cried, others felt relief. The cult of personality that had defined the company for 9 years vanished in a single press statement. SoftBank installed 2 co-CEOs, Sebastian Gunningham and Artie Minson, both seasoned operators with zero charisma and maximum competence. Their mandate was simple: stop the bleeding, cut costs, prepare for a future where WeWork was a real estate company, not a tech unicorn. By February 2020, SoftBank brought in Sandeep Mathrani, a real estate veteran who had turned around bankrupt mall operator General Growth Properties. His reputation was built on one thing: surviving the uncertainty. Over the next 18 months, they slashed 40% of the workforce. 13,000 jobs gone. They closed underperforming locations in secondary markets. They renegotiated leases, begging landlords for concessions. They sold Neumann's vanity projects, the Wavepool Company, the Coding Academy, the urban farming startup. By March 2020, WeWork had a plan, a path to profitability, a realistic valuation. Then COVID-19 hit. The pandemic didn't just challenge WeWork, it negated its entire existence. Shared office space during a global health crisis wasn't community, it was contagion. Companies that had signed multi-year contracts activated force majeure clauses and stopped paying. Startups that fueled WeWork's membership growth went bankrupt by the thousands. Remote work, the trend WeWork had positioned itself against, became the default for white-collar America. By June 2020, WeWork's occupancy rate dropped to 18%. That meant 82% of desks sat empty while rent came due every month on long-term leases Neumann had signed at the peak of the market. SoftBank, already reeling from losses across its portfolio, had no choice. They structured a rescue package in May 2020. $5 billion in new debt and equity, not an investment, a life support machine. The deal came with brutal terms. Existing shareholders saw their stakes diluted to almost nothing. The valuation, $2.9 billion, down from $47 billion just 18 months earlier. A 94% collapse. In October 2021, WeWork finally went public through a SPAC merger at a $9 billion valuation. The market briefly celebrated the comeback narrative, but the fundamentals hadn't changed. Losses continued. Occupancy remained weak. The stock price, which opened at $10, dropped to under $2 within 12 months. Neumann, watching from his Hamptons estate, issued no statement. His Instagram, once filled with inspirational quotes about consciousness and community, went dark. November 6, 2023. WeWork filed for Chapter 11 bankruptcy protection in the United States Bankruptcy Court for the District of New Jersey. The filing listed $32 billion in assets against $46 billion in liabilities. The math was final. The company that promised to revolutionize work couldn't pay its landlords. The locations that once symbolized millennial ambition now sat empty. Branded signs peeling off buildings from Manhattan to Mumbai, SoftBank wrote off approximately $11.5 billion in losses, the largest venture capital wipeout in history. Masayoshi Son, in a rare public admission, told investors that backing Neumann was his greatest mistake, not the valuation. The man himself. By June 2024, WeWork emerged from bankruptcy as a smaller, privately held company focused on enterprise clients and realistic unit economics. John Santora, the new CEO, never mentioned Neumann's name. The mission statement about elevating consciousness was replaced with language about flexible workspace solutions. The reckoning was complete. So what was the lethal decision? The one mistake that turned a billion-dollar idea into a $40-7 billion lesson. It wasn't the self-healing. It wasn't the corporate governance failures. It wasn't even the insane valuation. It was Neumann's fundamental belief that storytelling could replace substance, that charisma could override economics, that if you repeated the vision loud enough, the numbers would eventually bend to your will. Wall Street rewarded that delusion for years because cheap money made belief profitable. But when the S1 forced transparency, when every investor could see the bleeding in black and white, the story collapsed. The market doesn't care about consciousness. It cares about cash flow. It doesn't reward vision. It rewards execution. And when you confuse the two, it doesn't just punish you, it erases you. Neumann built a $47 billion monument to the danger of believing your own myth. He convinced the smartest investors on the planet that a real estate company was a technology platform. He made them accomplices in the delusion. And when it fell apart, he walked away with nearly $1 billion, while 13,000 employees lost their jobs. That's the untold madness. Not that Neumann failed. Everyone fails. The madness was that he convinced the world to fail with him, then negotiated a golden parachute while the empire burned. Today, in January 2026, Neumann runs a residential real estate startup called Flow. It's backed by over $350 million from Andreessen Horowitz, the same venture capital firm that lost money on WeWork. In June 2025, Mark Andreessen announced plans to double down on the investment, signaling continued belief in Neumann's vision despite the WeWork collapse. The pitch: communal living with purpose-driven design. The same language, the same promise of community, the same charisma. Wall Street isn't laughing anymore. They're watching. Because the greatest trick Adam Neumann ever pulled wasn't building WeWork. It was making people believe he learned his lesson. The S1 that destroyed his empire's public record. Every mistake is documented. Every red flag is visible. Yet investors are lining up again. Not because the fundamentals changed. Because they want to believe the story is different this time. That's the real lesson of WeWork. The market punishes delusion, but it never stops rewarding the storytellers who can make you forget the last time you got burned. If this story proved to you that ego without execution is just expensive theater, then you understand why unstoppable companies aren't built on vision alone. They're built on math that works when the charisma fades. Subscribe to this channel, turn on notifications, and share this with someone who needs to hear that the market always wins. Always. Because the next giant isn't the loudest voice in the room. It's the one who knows that survival isn't about never quitting. It's about knowing when your story and your numbers finally match.